Hello and good afternoon. I welcome you to today's special webinar here, exclusively for JFD brokers. NFPs ahead, which scenarios to expect. My name is Jens Klatt. I'm the Global Head of Research and Education here at JFD Brokers. And in the upcoming hour, I want to guide you through my thoughts around the upcoming NFPs tomorrow. Last month, the NFPs came out very, very good. So strong, above 300,000. And where, in fact, when looking at the price action, not bringing us so much volatility. So that came with a surprise. And I think, and this is something I want to mention right here while we're clicking through the risk disclaimer, I think this is something which could be a problem for tomorrow's NFPs too. So all in all, I think the focus right now is switching dramatically from the economic calendar over to especially the discussions here around the tariffs from the US on especially Chinese products and the other way around. So a potential trade war, which is coming closer, let's say. And so with this said, the current price action, for example, here, this is a chart of the DAX. All in all, we can see that the overall price structure or price action market structure is quite choppy, especially when looking at the short-term time frame here from the end of April. End of March onwards. Even though today we have seen, and this comes with a surprise, a break here above 12,130 to 160 points. And this was, mainly induced by what? I don't know. So yesterday here, the Chinese came up with counter measures against the tariffs from Donald Trump, and they attacked. Let's put it that way. It could be expected that something like this happens, but nevertheless, they come up with something which I, in fact, wasn't aware of, and which is most likely the reason here why the market, in this case, European equity markets, saw some serious pressure, sold off. The DAX here, in fact, broke below 11,900 points. And this is because, and therefore, 1 second. So I've prepared already something here on the NFPs, which we want to have a look at a little later on. But first of all, let's have a look here at the current situations. In the markets here, also with the market opening of US markets ahead of us in around 25 to 30 minutes. So this is very interesting. So some of you might have wondered, why are there now tariffs from the Chinese on soybeans? And in fact, it's quite easy to understand this. This is a chart which was prepared here from Zero Hedge, or I retweeted it from Zero Hedge, but the source is the US Department of Agriculture. You can see it here. And what you can see is that China is the main destination for US agricultural exports, accounting for nearly 14% of the US exports in January till November 2017. And China here in this context is a key buyer of sorghum, respectively soybeans, and this is something you can see here with this blue column. And also here you can see the China shares of total U.S. agricultural products exports January till November 2017. Also here, sorghum and soybeans are on top of that. And with this said, it becomes obvious why the markets reacted initially with a small sell-off in case of the European equity markets and the DAX, which dropped here by 200 points, something like that. The main reason is that even though the impact has to be, we have to wait if it really has a negative impact on the US economy at all. But with the knowledge around a still flattening 2-year, 10-year yield curve here, which is currently, which has flattened. I'm not sure whether we stayed there or we stay there still. We are there still below 50 basis points. And this is a first indication that there's potentially a recession ahead of us. And not only that the recession is ahead of us, but there's also fear that here the rate hikes from the Fed could become a problem and that the overall economic growth in the US is in danger. And with this said, such a tariff here from the Chinese, which again could have been expected, nevertheless, on our agriculture products here, and especially soybeans, was capable of at least inducing some kind of risk aversion in the markets. And yeah, that's potentially the reason why yesterday European markets sold off, and also the US equities sold off overnight. We have to call this so in the overnight trading session. So that was here, but then recovered, and not only recovered, but recovered sharply. So that was a huge and big reversal. Therefore, let's have a look instead of the S&P here on the Dow Jones. We've seen a very, very strong reaction against this blue line again. This is the 200 simple moving average. And I've said this in several morning meetings, English morning meetings here over the last days, especially on Tuesday. That was, in fact, the first trading day of the week for the German equity markets. We had a bank holiday on Monday, and so in fact the DAX hasn't seen any kind of bigger moves here on Monday, or let's say not one move at all, because markets were closed. But when it came in, the question was, do we get to see a break here? Was it only a small test, or will there be a follow through in the US equity markets of this 200 simple moving average? If the follow through occurs, there's further aggressive selling pressure potentially ahead of us. And this could have driven European, especially German equities then aggressively lower too. But I said also that there's a good chance that we probably hold this level, since what we know is that the 200 simple moving average is usually a good and solid support. And from here, usually you get to see some bids coming into the market, which are then pushing equities higher. And this is something which already came here into play on a Wednesday. Then yesterday, things turned sour initially after the announcement from the Chinese, but then the market reversed. And as you can see here, yesterday, the lows were at 23,397. And currently, we are obviously up 1,000 points. And this is within 1 day, in fact. And this is a very, very strong reaction, which is currently also driving European equities higher. And now you might ask, okay, what's the reason for that? I can't tell you. I really have no idea why now optimism is gaining a momentum here, and why the market is capable of shaking these fears around tariffs and trade war fears, is capable of shaking it off. All I can say is what I know. That was also something I read yesterday in the evening on Zero Hedge, was that the volume here in this up move declines, which is usually a sign that this is probably a quite weak move. Nevertheless, it doesn't look as if you come out ahead if you now short the market. Or put it differently, in the morning, in the German version of the morning meeting here, I told the audience that I'd be really, really careful to aggressively short the market. So, or give you a little anecdote here. So in the morning, I received an email from a client of mine who asked whether going short the DAX is a good option here. So that was based on a trading strategy we call open range breakout. And it's not only that we will probably also present it here in the upcoming minutes, how to trade the US market opening, but you can use it on several markets, for example, also on the DAX. And I told him that I can fully understand why he's skeptical and does not want to go aggressively long here. Why aggressively? Well, have a look at this. I mean, the market yesterday bottomed out at something like 11,800 points and took off from there, never looked back, and traded over 300 points higher in the morning around the spot market opening of the German equity markets. So with this said, the market can be easily described as at least extended on the upside. And so risk rewards for long engagements are not that attractive anymore. But the same is true for short engagements too, I told him, because the problem here is that if you see such a huge reversal, it's usually a sign that buyers are coming into the market. Again, the only problem with this is that I know that, for example, volume declined here on this push higher. Nevertheless, usually you do not expect the market to sell off such a such a big green candle, or respectively such a reversal candle without an external trigger. So if there's no external trigger, you should be really careful to expect the market really collapsing here. And that's exactly what we get to see right here, respectively what we got to see in the morning. So the market, yes, found some resistance here on the upside, something like 12,190 points, 180, 190 points, and then dropped slightly. Nevertheless, there was never, ever really big selling pressure coming into the market, but instead the market triggered long again against here the 50 exponential moving average, our classic trend filter, and from here made new intraday highs. And this is the perfect example of why it's very, very dangerous, in fact, after such a solid run here on the upside, to go for anti-cyclical short engagements, because such power candles, in fact, you can show this from a statistical standpoint, such power candles usually will be followed by further gains. So the market is more likely to continue to rise instead of, in this case, then seeing a sharp drop, and the other way around. Sure, if you get to see a sharp sell-off, that's usually also quite often the case, that the market sees the sharp sell-off and instead of reversing is then continuing to slip on the downside. Yesterday, well, we have to say that was an example, even though the candle hasn't closed here. What I mean by that is that such a move here on the downside, we're not talking about a daily candle, but it's only the first 2-3 hours of the trading day. But in fact, this is it's very difficult to say. What's the main driver here? Now, why do I go into so much details here around this trade war and the current price action we get to see in equity markets? Main reason is because I think that that this is the main driver for the current price action in general, and that tomorrow with the non-farm payrolls, we don't have such a huge chance to see big volatility, neither in the equity markets nor in the currency markets, for example. So I'm really doubtful here whether there's such a huge chance to see volatility, and that's something you could have seen yesterday already. So let's switch over here from the DAX. Let's switch over to the EURUSD, and let's have a look here at the 50-minute chart too, because this makes it more likely that you see what I'm talking about, what I'm referring to here. So when you look at yesterday, 14:15, that was it is in fact 12:15 p.m. GMT. So when you look at this candle, you can see that it's not impressive at all. So it's like it's nothing. This one here. It's followed by a quite green candle, but the market overall presents itself choppy. Then we get to see at in this case here 4 p.m. German time. So this is 2 p.m. GMT. You see an acceleration, which is nevertheless sold off in the upcoming minutes, and then into the evening, we don't get to see big moves at all anymore. So now the question arises, okay, and what you want to tell with this? 12:15 and 2 p.m. GMT. That has something to do with the numbers which came out yesterday around this time. Therefore, let's go over to jfdbrokers.com, and here, let's have a look. This is the English site. And let's have a look here at the research and education section. It's here JFD Research. And here you can find, once scrolling down a little, an economic calendar. What you can see is, let's go here to yesterday, Wednesday. You can see that at 12:15 p.m. GMT, we had the ADP non-farm employment change. And at 2, we had the ISM non-manufacturing PMI. And especially here around the ADP, we know that there is usually a quite good indication, or that the ADP data set in general is usually a quite good indication for the NFPs to come. So if we go over here to tradingeconomics.com and then we click on countries, there you can see United States, and there you can go over to labor, and there we have right here at the first place ADP employment change. So we click on this, we can see numbers came in above expectation, in fact. So it's 241,000 workers which were hired here in private businesses or by private businesses in March, compared with an upwardly revised 246,000 in February. So let's go back here. Number which came out was 200. Oh, I'm sorry. I think they changed it. Yeah, they were revised on the upside. I'm not sure if it was really 208 which came out. Yes, I'm sorry. No, here 195. If this number is true, so that's a little unfortunate, but nevertheless, I mean that doesn't matter at all. What I want to refer to is that we can drive, or we can compare the ADP data here to the non-farm payrolls, and even though there from time to time there are surprises on the up or on the downside. Let's put it that way. For example, here ADP once disappointed. It was somewhere at the end of 2016, probably at the beginning of 2017. The dotted line, which is non-farm payrolls, came in here at 150,000 and not disappointing as the numbers before. But we also have it the other way around. For example, here it was somewhere in 2015. You can see that ADP came in as expected, I think, somewhere around 200,000, while non-farm payrolls disappointed massively here. And nevertheless, if you carefully watch, you can see that the likelihood that the ADP data set is a good indication for the NFPs is higher than it's not. And last month, for example, NFPs came in above expectation, so with over 300,000, while ADP came in strong, nevertheless not as strong as the NFPs then came out. But, and this is the thing, when you look here at this alone, at this development, let's have a look back at the 4-hour chart in the EURUSD, and let's have a look at how the market reacted to this data set. So that was on the 8th of March, if I'm not mistaken. The 8th? Let me just have a look here. Oh, it was the 9th, I think. Yeah, it was the 9th. Here. 1 second. Is it true? Or was it the 2nd? I'm not sure. So usually it's on the 1st of March, but not sure for last month. I could imagine it was the 9th, if I'm not mistaken. Huh. Let us Google this. It's probably NFPs. NFP March 2018. Compare 9th, yes. So 9th of March. So that's one of the few times when NFPs weren't released on the first Friday of the month. And if we now go back here in the 4-hour chart, what you can see is, yes, there was some volatility, but the main volatility, in fact, came into play on the 8th already, 8th of March, and wasn't followed through by big volatility here. So look at this. I mean, this is the 9th of March. That was the day when the NFPs were released. Okay, nothing happened. So in fact, it's overall only some choppy price action. And again, let's have a look here at this chart. Data came in significantly above expectation, and really with a very positive attitude here. And I think this development alone illustrates perfectly that the current market conditions, the current let's call it fashion, is definitely not economic data focused here, but we have other potential drivers. And even here, we have to be really careful, because all the discussions around tariffs and actions taken by the US government, and then they are countered by the Chinese government, for example, all these developments here driving equity prices higher or lower and resulting in volatility. But in the currency markets, obviously nothing really happens. It's no big deal at all. And I fear that tomorrow we'll get to see a similar development here, even though we know that NFPs usually should result in higher volatility. Chances that it really will, I think, are very, very low. And that has not only to do with the fact that here, when looking at this development last month, that we just say, okay, now it will be the same this month, but it has also something to do with the fact that when looking at the economic calendar, and therefore I highly recommend to do the following: go over to Bloomberg.com, and on Bloomberg you can find here, you can you can find this sign here. If you click on this, you can go over to economic calendar, and there under the economic calendar tab, let me just do it that way. Probably it's better. So there's the menu. you click on menu. If you click on menu and here under Bloomberg Markets under economic calendar, you're forwarded to the economic calendar, which here on Friday, April 6th, shows the employment situation. If you click on this, it's really great to see that you have lots of data, and you get a very good impression of what the market is expecting for this news event. And in fact, it's very important to have this because it's not unusual. And if you, for example, only look here at the economic calendar, look at what market is expecting, and look at the US non-farm payrolls, you can see here forecast 166,000. We have the previous number. That's it. So then on top of that, you probably also look at something like the unemployment rate, which is expected to come in at 4%. You have the participation rate, average hourly earnings, and all this. But, and this is the thing, sometimes the market comes in better than expected, but does the complete opposite of what was expected. So let's say numbers come in better than expected. You usually expect a higher likelihood that the central bank, in this case the Fed, will hike rates, or at least be on a more restrictive course and have a more restrictive monetary policy. But instead of rising, the US dollar gaining momentum, for example, against the euro, the market does the complete opposite. US dollar sells off while gold is rising, EURUSD is rising. And so one reason for that is most of the time that the market has already priced in something which market participants, traders which haven't looked here at these forecast numbers, haven't seen yet. So for example, in case of the non-farm payrolls, the number which will be published here at 12:30 p.m. GMT, for example, what's the consensus range? And if you look at such a consensus range here, between 112,000 to 225,000, this is the numbers expected from analysts which were asked by Bloomberg, what do you expect for the NFPs tomorrow? So I'll put it differently. Let me try to illustrate this, even though it's very rough, but you get a very good idea of the concept behind this, I think. So let me just see whether this works or not. Just hope so. Whoop. So, and then let's do the second one here too. Oh, no. Here's the second one. Now let's do it that way. Oh, not sure. That's not so cool. 1 second. Let me do it like this. Probably it's even better. I just explained to you what I do here, even though that looks a little weird. Okay, 1 second. So let's assume this is 100,000 here, so 100K. And here we have something like 250 or so, 250K. And this is somewhere in the middle, something like, in this case, so 175. 175K. So what do I want to show by this is very simple. What we get to see here, this is the current consensus range. So which means if the numbers come out somewhere here or somewhere here, or also somewhere here around what was expected, you're not surprised at all, because this was already expected. The market just expected such a broad, or had such a broad consensus here, because analysts which were asked said, well, something like 120,000. Some said, well, 220,000. And so it's a very good mixture, let's say. Now, if you have such a broad consensus, chances are massively decreasing that you get to see a surprise on the up or on the downside. So, or put it differently, to be surprised, the market or the non-farm payrolls need to come out significantly above 225,000. That's not unlikely based on the good ADP data set, for example. Nevertheless, it's something which is obviously, and even then, we can't be sure that it's really creating some kind of volatility and is considered an action event. This is completely different when looking at this one here, at this graph in the middle. Well, why? Well, because you have potential here from, let's say, something like 160,000 to 185, 190,000, if at all. And everything which goes on this side or on this side, so is surprising on the up or is surprising here on the downside and comes out somewhere here, respectively somewhere here, is considered, should be considered a surprise. And in this context then, it means that such a consensus range here is more likely to trigger volatility than such a wide one. And now, when looking here at this consensus range, you can see that's over 100,000, over 100,000 wide. Let's put it that way. So now some might say, okay, but let's face it. I mean, is the employment situation here, respectively the non-farm payroll change, month-on-month change, is it really that significant? Don't you, or didn't you say over the past months here that the main focus is probably more likely here at this number, average hourly earnings month-on-month, but also average hourly earnings year-on-year? Yes, you're completely right. But here, another idea comes into play. So when looking at, in this case, Google, and that's Google FedWatch tool, what you can see here is the current likelihood of the Fed hiking rates at one of the next events. So May is a non-event because May is not a live event. And that's one of the reasons why here likelihood of the Fed not moving at all and hiking rates is close to 100%. But let's have a look here at June, for example. So this is the current level. And here we can see that in June, the Fed is expected to hike rates by 25 basis points. And even if numbers tomorrow come in significantly above expectation or significantly below expectation, which will already be very difficult based on the consensus range, it won't move this probability at all because it's only one data set. It's not a big deal. And this said, the NFPs to be volatile tomorrow based on average hourly earnings, which are more likely if this number rises here in this context. So it comes out, consensus currently is 0.3. Let's imagine to come out at 0.2. Let's say it's 0.4, whatever. Whatever number this is, it won't, or no, it's very unlikely to affect the expectation of market participants that here volatility will be, in this case, then massively affected on the downside and resulting in the Fed to say, okay, guys, sorry, but we won't hike rates. Also, another reason why we shouldn't expect them to the non-farm payrolls tomorrow to act as kind of an action event, volatility event. So now you might say, okay, June. Well, let's move on. Let's have a look here at September. So August again is not the live event. That's why we just skip it. But what's in September the case? Well, in September, obviously, nearly 60% of market participants expect another rate hike. Here, chances are given that if numbers really disappoint, especially from an average hourly expectation perspective, average hourly earnings, not expectation, average hourly earnings perspective, if they disappoint massively on the downside, that this could somehow affect probably this probability a little. So the likelihood that the Fed will move then into the second half of the year and probably consider only one rate hike, the one in June, and not doing anything in September, and on top of that, not doing anything at all in December as well. But again, it's just a too short time frame that a negative data set tomorrow not only around the non-farm payrolls, but also around the average hourly earnings can affect the position or the likelihood of the Fed moving here and hiking rates, that it can really affect this at all. And this said, again, chances are very, very slim, I think, that we get to see volatility at all. And this said, to be honest, I'm a little unhappy to say that, but that's just how it is. I mean, probably for whatever reason, there will be some momentum building now on the downside. So EURUSD has seen, or at least has gained some momentum over the last hours of trading. So probably we are about to see at least a quite significant attack of the region around 128.70, 121. I'm sorry, 121.70, 122.20 here, and but this is mainly and most of the time driven by technical reasons, not necessarily by the non-farm payrolls tomorrow. But if we attack this level and if we break this level, well, then chances are quite good, quite high that this is not the end here, but probably EURUSD will then also dig a little deeper and probably attack the region around psychologically relevant 120 region around. Such a push lower, by the way, does not necessarily need the help from the labor market here in the US, but probably is driven by something else. And therefore, let us Google something which I came across, or respectively several, in fact, came across, Libor OIS spread, and then EXY. So why do we do this? Let's have a look here at this picture, and let me just see. I think it gets the job done. So what do we see here? So first of all, what's the Libor OIS? That sounds very, very cryptic, but it's not at all, in fact. Libor is a London interbank offered rate. That means this is the rate to which banks overnight lend themselves money, respectively here on a 3-month time frame. And OIS, in fact, is the, let's call it risk-free yields. This is sometimes, in fact, OIS, I refer to OIS when trying to give an idea on how likely is it that a central bank will hike rates at their next meeting. Sometimes the OIS, the swap markets here, give a very good indication. Interesting enough is that the Libor OIS spread is something which came to the mind of many market participants around the financial crisis in 2007, 2008. Because if it starts to spike higher, as it does currently, at least around the financial crisis, it was an indication that the conditions in the credit market went massively sour, let's say. So the thing was that banks did not know whether the counterpart, the bank they were lending money to overnight, was still there tomorrow, especially after the collapse of Lehman Brothers in 2008. And this said, it was in fact some kind of the end of the credit market. And one of the main reasons why equities collapsed 2008, 2009 was because there was no liquidity available anymore. And what did central banks do since then, in fact? Well, they started to flood the markets with liquidity. They made money available in a very, very cheap way to save the financial system, if you want. So in fact, the Libor OIS spread is a very good indication. And if it starts to rise, it's definitely a good reason to worry about it, because it indicated, respectively indicates that there's kind of a credit crunch, respectively a liquidity issue in the credit markets. In our case today, many market participants come out and say, well, this is probably not necessarily the case today, because it can also be that, for example, here, the Fed is hiking rates and short-term rates are rising quite aggressively. That's also one of the reasons why the yield spread between 2- and 10-year yields keeps on collapsing nevertheless, it's still also an indication, and an indication which everyone should be aware of, that there is a recession in the US around the corner. And so the thing is that this usually drives also the yields higher, short-term yields higher for banks overnight, and could be one of the main reasons why the Libor here is spiking higher, respectively the Libor OIS spread is spiking higher. But also, and this is also something everyone should be aware of, current market conditions, or not current market conditions, but the trade war, especially between the US and China. We should be aware that China, after Japan, is the biggest creditor of the US. And they mentioned several times, I don't, yeah, let's put it very direct, very rough. It's not a quote here. I'm not quoting anyone, but it was like, if you carefully listen to what they said, it was like, okay, Mr. Trump, stop your attacks on the Chinese here, else we will stop buying your bonds. And that was also one of the reasons why yields spiked higher. And so this discussion around tariffs can easily swap over here to the credit markets and could result in a liquidity issue, which is one of the main drivers currently for Libor OIS spread to move higher, and could then also result in a quite aggressive sell-off rather sooner than later. And after this let's call it a short introduction to the Libor OIS spread, why is this interesting? Well, what we see here, this is the turquoise line. The blue line is the DXY. What's the DXY? It's the US dollar index future. And we can have a look here at the DXY at this chart. So what do we see? Well, we see that obviously the market, the US dollar index future, finds itself in a quite strong downtrend since the beginning of 2017, but is probably about to break out of this channel and probably to play kind of, let's call it catch up with this Libor OIS spread here. And this is something where we could say, okay, do we really need the non-farm payrolls tomorrow to surprise on the upside, or the Fed to keep on hiking rates? Not necessarily. If this correlation continues, then we can definitely say that here the US dollar could rise only because of the Libor OIS spread having risen already dramatically. And in this context, that the DXY just lags behind and will rather sooner or later play catch up here. If this happens, well, then again, dollar also should gain against the euro. Where is it? Here. And there's a good chance that there will be such a push lower, and that this consolidation here is, that this consolidation will be broken here on the downside instead of the upside. Currently, it's a bullish consolidation, and we're still in a very bullish market environment. But again, volatility is massively decreasing, and chances are rising that rather sooner or later there will be a volatility breakout. Again, not necessarily tomorrow with the NFPs, but in the near future probably. And if this really happens, currently the likelihood, or the higher probability, seems to be on the upside. Nevertheless, chances are given that this could also occur on the downside if here DXY, which lags behind the Libor OIS, plays catch up and rises sharply. So yeah, that's it on my thoughts here on the US dollar. Let's probably finally, and that's well, not just finally, another currency pair, and then finally on gold. Let's have a look here at the dollar Japanese yen. So currently, I wouldn't call myself a big fan of dollar Japanese yen, because therefore, when you look here, the price action does not justify to be a big friend of this currency pair. If you look here at the fact that the market conditions can be considered very choppy, neutral, there's no real advantage to be seen here. But nevertheless, if you had to say what is more likely, dollar yen going up or down, probably based on the current conditions, you probably will say the advantage can be found on the downside, at least as long as we trade below 107.50 to 108. So currently we are moving towards this to this level, and probably because we know that the Japanese yen is quite yield sensitive, probably with non-farm payrolls coming out better than expected tomorrow, and if they can somehow affect the yields here, push them higher, probably we get to see a quite significant attack around or at the region here around 107.50 to 108. But all in all, before this and everything below 107.50 to 108, we should consider dollar Japanese yen and the advantage here given on the downside, I think. And by the way, if you want to have a long-term outlook for dollar Japanese yen, I think that it's more likely that we're going south and test the region of 100 instead of rising sharply. It has something to do with the developments around Shinzo Abe in Japan. So let's call him the founder of Abenomics. I heard it's minimum rumors. I heard that he is probably under serious pressure here, and there's fears rising that probably Shinzo Abe will be rather sooner than later, fired. I think this is the wrong word. It would be the right one when talking about Donald Trump. But 1 second, let me just see. I only remember the German word for this. Can we call it deselected? Probably it's the best. Yeah, so deselected. So there's a chance that he probably lose at least influence here from a political landscape. And this is something which could then, if the Bank of Japan steps back from their asset purchase program, this could result in Japanese yen see some serious strength here on a broad front, by the way, not only against the US dollar, but if I had to make a call here, I'd say it's more likely that we go down to 100 in the upcoming months instead of seeing a rise, a sharp rise here on the upside. By the way, the current move seems to be also driven by the fact that risk aversion currently is going out of the markets here. Nevertheless, I still consider chances to be high that there will be higher volatility over the months to come, with more potential on the downside, especially from August, September onwards, probably. So into autumn, late summer, autumn here, and with there's only a gut feeling. But if we get to see higher volatility late summer, respectively autumn here, chances are also high that the Japanese yen will see some strength too. That could be another driver which drives Japanese yen higher, respectively dollar Japanese lower. And yeah, by the way, we now are about to open the US markets here. Let me just give you a short explanation of what I just did. So respectively of my picture here in general. So what we have is these vertical lines, the gray ones. They're showing the main trading hours, the spot trading hours. When Wall Street is open, that's from 1:30 p.m. GMT till 8 p.m. GMT. And this is the time when the main liquidity, the main volume can be found in the market, and moves are should be considered more significant. The red line is the high from yesterday. The green line is the low from yesterday. Obviously, the turquoise line, it's not obvious, but the turquoise line is the first tick at 1:30 p.m. GMT. So it's the so-called spot open. And we are opening above the red line, which indicates that we are currently seeing a true gap compared to the price action from yesterday. So if we are opening out of the trading range from the day before, above the red or below the green line, I call it a gap, a true gap. And it's not unlikely that the market first closes this gap and then probably keeps on trading in direction of the current momentum, which can be clearly found on the upside. The deep blue line, by the way, here, or royal blue line, this is the close yesterday at 8 p.m. GMT. And yeah, the exponential moving average 10 here is my trend filter. And what I now do is, in fact, I wait for the first 45 minutes of trading. And after that, I'll buy the break out of this trading range in direction of the identified advantage. So let me give you an example, even though it's a very fantastic example, because yesterday it was a one-way street and we were triggered with the setup on the long side. And so this line here will show you the highest high of the first 3 candles. So this is the first 45 minutes of trading, 3 times 15 minutes, it's 45. And then we have also a low here, which is here. And so what we do is obviously we buy the break out of this range because we are trading above this yellow line, which is the exponential moving average 10 on a 50-minute time frame. We're going long here. And the setup says that we keep the trade open till the end of the trading day, in this case, 10 minutes before the spot market closes. That means 7:50 p.m. GMT currently. We're closing out the trade. That was somewhere here. So you're buying it here, the breakout, placing the stop below the low of this range. And then the market, yeah, happily enough for us, takes off and trades as high as 2,600 and I don't know, 40, 45. And somewhere here, the trade is closed out and bringing us a profit of something like 45 to 50 points on average, while we had a risk, in fact, of 25 points here yesterday. Again, breakout here. This is the long trigger. That is where you place the stop, and then you go for the setup. Now, by the way, the question will arise, is this really a profitable setup here? Yes, it is, in fact. I just want to show you a chart here. That's usually the what I just present to you here. This is what I present on every Thursday here on the FX Street webinars for JFD brokers. If it's not the first Thursday of the month, so the day before the non-farm payrolls, in fact. So let me just show you the chart here. So this is the backtest result for this strategy I just presented, long and short, by the way. I'm sorry, that wasn't right. So, and as you can see here, it's a nice rising curve with significantly higher highs and higher lows. And you have a hit rate here of 47%. We're, by the way, looking at 1,347 trades here. The backtest result here, that was a snapshot. We held a special webinar, Stefan Frichowski and I together. And he worked this out. So he is obviously very quantitative in his trading. Probably also that has something to do with the fact that he has a PhD in physics. So he had some connection issues with his internet when we held the presentation here. And then they just took a snapshot. And several seconds after I took the snapshot, he just was cut off. And I could nevertheless take over because I'm trading this strategy, and he only wanted to present hard facts here to the audience. And yeah, so what you can see is that the backtest, which he ran for a time span of something like 7 years back towards November 2010 here, resulted in a hit rate of 47%, and the average profit to average loss ratio here comes in at 1.31 to 1. If you multiply this with the hit rate here, you get on average an expected value per trade. Doesn't matter if it's a winning or losing trade, but the expected value per trade from 8 cents per euro your risk. And the SAD, yeah, perfectly illustrates that this approach obviously has a positive expected value then connected to it. And yeah, so in fact, this is the theory behind this approach I just presented. It's a perfect example here. Worked out brutally great yesterday, but you can imagine under such market conditions here as on Tuesday. If it's such a choppy market conditions, obviously you face a losing trade. So you're here. That's when the market starts to trade. First 3 candles. This is the low. You're trading below this. You're entering the trade once we break to new lower lows here, and then the market pushes higher to new intraday highs. Not significantly, in fact, but nevertheless, this is where you get stopped out. So this is a losing trade. Classic example of a losing trade. So yesterday is perfect to illustrate here, even though this is perfectly for the last 2 days, because something we should expect by if you have a hit rate of 47%, that means that in 50%, all in all, in 50% of the cases you're on the wrong side, and 50% of the cases you're on the short side, or on the wrong side and on the right side. And yeah, so in fact, that's it. Are there any questions so far? So we can easily switch over here and have a look at what's happening. So far, it seems as if the S&P really is closing this gap right now. And probably we're dipping a little deeper here and going down to 2,644. By the way, let me just see. Yeah, are there any questions so far? Again, that's very interesting. We have to wait another 25 minutes. Before that, we do not place any orders, and we don't even know if we take the trade, even though chances are high that there will be a breakout of this range. Let's have a look here at the DAX. What's happening here? Nothing more. So no real willingness to sell off sharply. And even if it does, we find quite strong support here already in the region around 12,160 to 180, I think. Even though probably you don't want to be aggressively long on an intraday perspective in the DAX in the evening anymore. First of all, because the evening is not the most attractive time to trade the DAX. And on top of that, if we really push below here to this region, 160 to 180, we are also dropping below the 50 exponential moving average, which is a trend indicator. And you don't want to be aggressively long below that, as you don't want to be aggressively short above this exponential moving average 50. Yeah. So no questions. No questions. Okay, so then, in fact, I don't have anything else to add here at this point. I just hope that that you appreciated the presented content. Please feel free to send me an email if you have any questions. I'll just give you here the email address again. 1 second. Whoopa. 1 sec. Okay, so there you can see it. By the way, let me just go back here. So this is my email address. But you can also contact me via Twitter. It's at Jens Klatt FX. Yeah, and so that's it from my end. So I hope you enjoyed the presentation, and I'd really appreciate it if you send me a mail or join us again next week then on Thursday. I really look forward to it, and yeah, I wish you all the best. Happy trading. Watch your stops. Take care, and talk to you again then next week. I'll definitely look forward to it. See you, and bye-bye.